Good evening, everyone, and welcome. It was another record close for the S&P 500, the fourth one in the past 5 sessions and the 16th of the year so far, and all the major averages ended the day with modest gains. That happened despite some sort of choppy, lackluster, really, data about the U.S. economy and light trading volume ahead of tomorrow's European Central Bank meeting and the biggie on Friday. That would be the May jobs report. Today, a setback in the labor market as a reading on private job creation last month was short of forecasts, and the U.S. trade gap got a lot wider in April. Worker productivity down in the first quarter of the year with all that snow and cold paralyzing factories, offices, retailers, and more. But just as winter turned to spring, we've seen some green shoots for the economy in recent weeks as it slowly, but maybe not so steadily, returns to growth. Steve Leisman has more.
It was a day of mixed economic data that, on balance, kept intact the view that the U.S. economy is snapping back from a winter of severe weather. But the data raised questions about the strength of that snapback. ADP reported that 179,000 private sector jobs were created in May. That's below the estimates of 210,000 on Wall Street for the government job report this Friday.
I'd say it's disappointing. It suggests that job growth, monthly job growth, is probably still south of 200,000 per month. And that's about where we've been for the past 3 years.
Meanwhile, the trade deficit came in billions above expectations with a surge of imports from China. A higher deficit subtracts from growth, so economists marked down first quarter gross domestic product to a 1.1% decline. And the second quarter rebound also took a hit, falling to plus 3.5% now. But the increased imports could mean that retailers found inventory levels too low and are restocking shelves confident in future sales and a robust consumer.
The economy seems like it's in a good shape. It's accelerating. Everything seems to be lining up nicely. If we can just avoid, an oil spill in the Gulf or bad winter weather or bad spring weather, then, we should be fine.
On the rosy side as well, the Fed's Beige Book, which collects economic anecdotes from around the country, said activity expanded in all 12 of its districts. All the districts also saw strength in manufacturing, especially autos and aerospace. The outlook for interest rates, as measured in a survey of market participants by CNBC, is improving as well. The 10-year government bond yield forecast to rise to just 2.9% by year end. That's down from a prior forecast of 3.25% in the last survey. And respondents forecast less central bank tightening by the Fed next year. Wall Street will follow closely tomorrow's announcement from the European Central Bank, where the survey shows expectations are for a rate cut, even charging a negative deposit rate, that is, making banks pay for keeping money on deposit at the ECB. That's a potentially historic development designed to combat waning inflation and waning growth on the continent. For Nightly Business Report, I'm Steve Leisman.